Okay, so the recording has started and I believe you can all see my slides. If someone cannot, could you please raise your hands? Okay, I guess everything is working fine then. So let us start. So a quick word about Famigos before we begin, just to give you an understanding of what we do. So we work with expat families and professionals here in Germany to help them achieve their financial goals, right? This is through, of course, a lot of coaching and also strategy planning and implementation services. And as I mentioned, so we are registered financial advisors here in Germany, and I understand that some of the audience today here is from different parts of the world. So of course, this session is relevant for you. But some of the points in terms of the opportunities which we might be talking about are Germany specific. So that might be something that you need to keep in mind and figure out how it works in your geographies, right? So that's the only sort of note of caution that I need to give. Then let's begin. So what's the agenda? What are we here to talk about? First and foremost is what to expect in this year in terms of financial conditions. The second is what do we make of these conditions? What are the opportunities which are relevant to us as individual investors, retail investors? And last but not the least, a quick word on how Famigos can help you if you do reach out for help. Before we start looking at this year, it's always good to take a quick look back, right? So let's take a quick look on what happened in the year 2024. Was it a normal year in terms of financial markets? Certainly not. Yeah, this is one of my favorite sort of graphic representations of how the markets have done. So what you see here are different years stacked according to the growth in capital markets that they saw, right? So if in the middle we see the years where the capital markets grew between 0 to 10% on the positive side, and of course on the left-hand side are the years with the worst performance, and on the right, as you go further down the lane, it shows how well those years were, right? If you look at the last 2 years, yeah, it's not only 2024, the last 2 years have seen more than 20% growth in their capital markets every year. Yeah. So we are definitely not going through the usual market cycles when it comes to stock markets and how the financial sort of markets have been behaving. Now, having that as a backdrop is very important because when we look in the future, right, we are coming off from the highs of the last 2 years. So the question, honestly, from a financial perspective is, can we sustain those highs over the next few years? If not, then is it all gloom and doom for us? And if we can sustain, then to what levels can we sustain? So this backdrop gives a very good idea of how you can look forward. Yeah. Then let's begin at the main themes, which we see from our perspective, the main topics, right, of what we can expect. 4 themes that which we're going to pick up, and then also show the impact of these themes on individual investors. The first one, of course, we cannot ignore this person and all the repercussions which would come along with him being there for the next 4 years, right? So there definitely going to be some surprises, but to a large extent, we can expect the kind of surprises, right? So that's why we say predictable. Second is what happens with the interest rates and inflation. These are closely related topics. They impact our daily life, right? Whether it comes to consumption, whether it comes to investment. So that's an important topic to have a view on. Thirdly, how all of these things, so let's say the macroeconomic situations, the geopolitical situations, what is the impact on the different economies and how do we see them growing, right? Last but not the least, how all of these factors impact capital markets. Yeah. Is equity still a positive thing to invest in or not, right? So this is the main theme, or rather the main themes of what we will talk about when we see what is going to happen in this year. Just a minute. I guess there are some people in the lobby. Just give me 1 second. Okay. We will continue. Yeah, so the 4 topics, this is what we're going to talk about. Let's start with the first one. Yeah, so this is something which, of course, all of us have been hearing in the news of late quite a lot, right? The tariffs which Trump has been talking about, of course, even during his election days. So these were the promises that he's made to the US citizens of what he's gonna do, right? And the chart here shows how the corporate America, which, if you see from a global sort of market, is still the most important economic market in the world, what they have been talking about, how these tariffs in terms of their earnings per share, right? So we are, let's say, right here. And what you can see is almost all the sectors in America have been talking about what the impact of these tariffs are going to be on them. Now, if you were to just have a quick look that, why these tariffs? So these tariffs are basically being used as a tool to generate revenue for the US government, right? Because they already have a budget deficit in terms of GDP more than 7%. However, there's something which is important from that perspective is that even if you go ahead with all of these tariffs, which let's say Trump has already announced, which is 25% for Canada and Mexico and 10% for China, right? The income which is expected to be generated from these tariffs is nowhere large enough to cover this budget deficit, which is already there, right? And what these tariffs could lead to would be, of course, retaliation, right, from different markets. We've already seen China come back with a 15% retaliatory tariff on all the US products. So it's like a double-edged sword. It might generate some income for the government of America, but at the same time, what it could do is shrink their own economy, right? So we need to sort of take a, how should I say, a little more neutral sort of view on whether these tariffs would actually be implemented in the long term, or are they just some short-term tools, which of course the US government could use to, let's say, try to bring the other economies in line, is how they talk about this, right? Um, of course, they also know, and when I say they, I'm talking about the US government, they also know that this is going to punish not only their economy, but also their citizens, right? Because when these tariffs are levied on a lot of products which are being exported from outside, of course, the exporters in different countries, they are imported, and the exporters in different countries, they cannot absorb all these additional costs. So they will be pushed on to the final consumer, right? Which is the US citizens. And which means that the inflation could come up again. So from our perspective, from a global perspective, right? Inflation in US could come up again if these tariffs are levied in the way they have already been sort of promised or planned, and also for the long term, right? Having said that, there's another aspect that we could need to look at, right? So Trump and Musk, of course, these are business people, right? They have always had a very high focus on maintaining the financial markets, right? They also think that as a symbol of their success, right? So from that perspective, I think it is going to be a really measured approach from their side. So my personal view on this is, of course, it might have some short-term impact in terms of, pushing up the inflation. However, it would be a much more measured response from these guys so that their domestic markets are also not impacted that much and their domestic economy is also not impacted that much, right? So I personally am going ahead with a slightly neutral way and not really like a doomsday scenario. Um, okay, then let's see how the debt markets are going to involve. That's the second topic. Now, of course, because of all this uncertainty, right? Geopolitical uncertainty, uncertainty about, okay, how the inflation is going to be controlled, right? Then comes a question of how are the interest rates developing? Now, interest rates are always, not always, but to a large extent driven by how inflation plays out, right? At this point of time, given the high uncertainty as to how the inflation might increase again, the interest rates are showing a huge bond premium. I'm not sure if how many of you are sort of familiar with this thing, but it basically shows that the investors in debt, how do they see the risk of keeping their money invested, in this asset class? Having said that, we do expect still a normalization of the interest rates. So as you already know, interest rates have been coming down across all geographies, right, over the last 2 years. Specifically, let's say talking about Germany, because this is where I am working, I am based. We started off at 4%, right? At the start of last year, we've come down to around 3%, at the end of last year. And what is expected is a further decrease of at least 1% to end around 2% by the end of this year. Yeah. So even though there might be a situation where the inflation goes up again, the general guideline or the direction of the interest rates they are still expected to come down. So from our perspective, when we are individual investors, right, this opens up some opportunities in the debt markets. Because when the interest rates come down, right, the prices of these debt instruments go up. So from an investor of, let's say, in debt funds, this is a good scenario for us. So if you have not already invested, probably that's another thing which you can think of from a short term, but also from a safe side of debt funds, is a possibility to have that advantage now before the interest rates are completely normalized. Okay, let's look at the different economies now, right? Now, it's quite interesting. Because I'm based in Munich, right? And we have a security council going on, the World Security Council, where different market leaders are coming and showing or basically talking about the main concerns that they see in their economies and all that stuff, security issues, how they could sort of, come together. But however, at least what we are seeing is that they're all following divergent paths. And this somehow seems to be the theme of the current times, that different geographies, different markets are following different paths at the moment, right? So we're sort of comparing, let's say, three markets, right? The States, of course, the EU, and Asia is a huge market. So if you were to just sort of take China as example, right? What do we expect as a GDP growth? Yeah, here we're not talking about the markets, the stock markets, but we're talking about the core growth in the GDP. Slightly lesser than last year, 2%. Of course, EU has been further low in the growth, less than 1%. China, of course, from a historical perspective, it is still a lackluster sort of expectation for this year. Inflation expected to go up slightly because of these tariff situations and the uncertainty, from 2% to 2.4%. In EU, broadly, last year we did come down to 2%, so more or less the same, and probably the same in China. Yeah, the interest rates we already talked about. From the strengths and the challenges perspective, of course, US still, given how the capital markets are structured, the composition of industries, they still have a high earnings potential, right? Plus, of course, there are these proposed regulations which are, to add stimulus to industrial sectors. But the question mark still is the tariff, right? Does it work in their favor, which is to generate income and close the budget deficit, or it works the other way around? Yeah. So this is what we mentioned here, because the other economies would retaliate. Um, and from, I think, one, of course, big challenge is that America is putting itself first, right? So, which is leading to a major shift in the trade policies, which have been there, let's say, for the last 10 to 15 years, which, most of the major economies have become quite comfortable with dealing with. So, it seems that there's going to be a significant change from that perspective. Yeah. And of course, if you were to specifically look at tariffs, EU has not yet come in the frame from the US perspective, but it is also expected to, right? This was just indicated yesterday in the Munich Security Council that they are not going to only stick to, let's say, Mexico, Canada, and then Far East China, but they are looking to also, have these tariffs implemented for a lot of European economies as well. Yeah. And Europe is already facing its own issues, right? Like, of course, we are low on growth, we have low consumer demand, we have our energy dependence on certain economies. But on a positive side, the inflation has, of course, come down, right? So it supports the increase of consumer demand. There has been increase in the real wages, and a lot of work is also being done on the industry side to stabilize it, to modernize it, and also another field of infrastructure is where EU is sort of investing a lot. So there are some, let's say, the positives, in this region, what we could look at. From China perspective, of course, on the positive side is from a value of the investment, it is still a positive kind of, how should I say, an opportunity in my mind, to be very honest, because the valuations are very reasonable as compared to the ones around the world, especially, let's say, the States. The government is always coming up with stimulus, different kind of plans. So they might work out, might not, but yet to be seen in the long term. And of course, they have issues with their overcapacities, which are created, and of course, the tariffs. Broadly speaking, from an investor perspective, right, all geographies have their challenges, but they also have their opportunities. So you as an individual investor, this situation only goes to show the importance of diversifying your investments. So your key takeaway from this slide could be that you need to diversify your investments probably all over the world and not stick to one sector, one geography, or one country. Now let's go to the most interesting bit, which is, of course, our capital markets, right? So last 2 years, amazing, right? 20%, 25% growth. And if most of you are invested, you would have already been very happy with how your portfolios are growing. But what happens next? Do we expect these bull markets to continue? Now, one of the major contributors, right, of these bull markets, and here is a chart specific to S&P, have been the Magnificent Seven, or let's say the big tech, right? So for the last few years, they really have been sort of driving, the markets up. But the question is, what about, if you were to just look at the S&P 500, what about the rest 493 companies? Yeah. Are they doing well enough? So that's the question which, we need to ask ourselves. If the big tech doesn't perform so well in the future, right, what happens to the rest of them? Are they good enough to kind of sustain the growth of the market? And this chart, to some extent, shows that yes, because the value of investments, stocks, shares, it is always linked to the expected earnings of these companies, right? So it's a direct correlation to what is expected from these companies as a result, as the financial results. And this chart shows that leave these Magnificent Seven aside, the other S&P 500 companies are also coming to the same level of expected earnings growth. Yeah. So this whole dependency of the stock markets on big tech, yes, it has been major over the last few years, but it may not be the same in the future. And that is a good news because we have growth kind of spread across different sectors as well. This is another chart which shows that how closely the forward PE, which is the forward valuation, is linked to their long-term earnings growth. Yeah, so this shows that as your long-term earnings growth is on the up, most likely your valuations would also be on the up. So from, again, my personal perspective, this is good news, right? So Magnificent Seven, the dependency of the markets on them is hopefully in the future not going to be as big as it has been in the past. Now let's talk about this year. Yeah, this is a very interesting chart. It shows how the S&P, we are using S&P because it sort of is an indication of, the US markets, which form 60% of the global capital markets. So you can, use it as an indication of the broad equity markets, right? So this is a projection. Last year, this is how it was projected. This gray area was how it was projected. And this is what the reality happened to be. So in more or less, the actual results stayed within the projected area. Yeah. And then this is the projections for this year. And again, this is based on the earnings growth. Yeah. It's all linked to the earnings, how the earnings have increased, and also what they are projected. At this point of time, as of Friday, right, the Sensex closed at almost like 6,100. So if you were to, let's say, look here, we are currently at the top end of these projections, right? And what was expected is that, probably because of these, of course, these tariff announcements, the market's going to go down and, doom and gloom, all that stuff. Till now, the markets have been resilient, but that's also because of a few other factors, because, Trump announced these tariffs and then they put them in hold, and the further discussions happening with Canada, Mexico, and we are still right here. Yeah. Now, given if the inflation increases, right, given the factor that the GDP growth across the world is not going to be significant. So there is a broad expectations that the markets are going to come down to some extent. Like probably here we are looking at, let's say, between a 5 to 10% decline over this year, right? So this is something from an individual investor perspective, you should keep in mind that the broad projections do show an impact on the industries, do show the impact of inflation, but broadly speaking, it is not going to be a huge downturn, is what is expected, right? And in another 3 months, 6 months, we'll probably have more clarity that, which way we are going to go. So broadly speaking, a cautious approach is advised at this point of time. A diversified approach is advised. And maybe another thing which I would probably add is if you're sitting on certain sort of, let's say, amount of money, you could keep it aside to look for a significant drop in the markets if it happens towards the end of the year, and then enter the markets. This is what we call as keeping a sort of crash cash on one side. So that's another opportunity which you could look at. But the ones who are invested, who are staying, let's say, in the markets, it's more or less, be there, stay there. It's of course a market turn, but nothing to be very, very worried about, my personal view. Okay, so now I guess we've talked about a lot of different trends. Yeah, so that's the first part which we wanted to talk about. Now let's look at what you can do in your situation, right? So I looked at all the questions, honestly. So we had almost, I think, more than 60 people who signed up for this one. Of course, we could not accommodate all of them, and I really do not know right now how many have probably finally joined. But at least I noted down all the questions which came from the interested audience to see what are the topics that they want to talk about and then basically answer those questions. Yeah, so this is a summarization of the questions which I received. The first one was all about risk. Yeah, people worrying about how do I enter, how do I put the money aside, how do I manage the risk situation? I'm very risk averse. So this was the main sort of, how I think is the starting point for most of us. The second question was about the markets. I don't know enough. I don't know the sector. I don't know the companies, where I should invest. I have no knowledge about the markets, situations, and all that stuff. So this was more from a broader perspective. The third one was slightly more specific thing that, okay, what are the profitable deals, for me? What shares, what ETFs, where should I invest? What are these new fancy investment ideas or opportunities, right? So a little going to the next level. And last but not the least, how should I do it? Like, what should be the method? I'm worried about these different, let's say, platforms available in the market. Am I going to be scammed? Yeah. How do I deal with taxes? How do I start investing? I don't have the initial capital. So this was then more a question about how should I do it? Yeah. So over the next 3 or 4 slides, I will try my best to address all of these topics one by one. Let's start with the first one. The risk. Yeah. So inherently from a financial situation, risk, how we define it is when a person is worried that by doing a certain kind of investment or a certain kind of financial action, his finances are going to be in a worse situation. Yeah. Now, the simplest thing to start working on this fund is be careful about your savings. It sounds very simple, but if you have a savings base set aside, right, this whole inherent risk question becomes easier for you. Your risk taking abilities increase once you have built a certain amount of, let's say, savings on one side. So quickly, my experience on what, given your life situations, you should be saving, right? So, because to be able to invest, you need to take risk, and to be able to take risk, you need to have this is like the starting point, right? Now, across different life cycles, right? Your ideal savings from a family perspective changes when you are, of course, young, right? Or you are two adults, two partners, the ability to save money is at its highest. When you come to a family situation, especially smaller kids, their education, their upbringing, a lot of other things, a requirement for a bigger house, this is where your savings could technically be the lowest, right? And then, of course, towards the later stages, once the kids sort of move out, they are independent, then your savings could come up again. So a very simple sort of a suggestion, you could always look at keeping at least 20% of your monthly income aside as savings. It is important to give yourself targets, because unless you do not give yourself targets, it's very difficult, yeah, to stick to the plan, right? To be able to have a certain amount of money kept aside. Yeah. So what we always suggest to our clients is to have an emergency fund kept aside, which should be equal to at least 4 to 6 months of your expenses. Yeah. If you have this much, at least this whole risk of your standard of living going down, if at all something goes wrong with your, let's say, work or your business, depending upon whatever you are doing to earn your livelihood, at least that risk is elevated, right? Um, and also, just having this emergency fund kept aside is not enough. It should also be invested to a certain extent in a very low risk investment so that it does not lose value. Yeah, so this is the first thing which we always ensure, and here I'm sharing my experience, how we work with our clients, is unless somebody has not done this, we do not even talk about investments because it does not make any sense. Yeah. So this is like a must have before you can start doing investments. And of course, given how our life stage impacts our ability to save money, the earlier you start, the better it is, right? And here is something, if you guys are interested, there's a QR code by which you can download our financial monthly budget template, which will help you figure out, okay, now how are you spending your money? How much can you save? And then, of course, set yourself targets and move ahead. Let me go ahead. Hopefully the people who wanted to take a picture have already done so. Okay, let's move ahead. Now, when we start working with our clients, there are some very practical tips or let's say tools which we use in help their budgeting. Yeah. So I want to also quickly share that before we, move to the next stage of how do we start investing. So the main question, to be very honest, is always when you're looking at budgeting, what are the opportunities to cut costs? Because every euro or dollar saved is, a dollar invested. As simple as that. Um, so some specific tools which we use, at least here in Germany with our clients here, is look at their insurances. Um, you could probably do the same in your geography, wherever you are based, is to figure out how you are spending on these insurances, because at the end of the day, they do add up to a lot of money, right? And most of the times, there is either a question of being overinsured, right, which of course leads to higher costs, or underinsured. And of course, switching players is also something which you can always use. There is one, sort of a very well kept secret in our industry, is that whenever you have all your insurances with one insurance player, right? One insurance company, you get a lot of significant discounts on that. Yeah. So keep that in mind when you go today and probably look at, okay, what are my insurances? If you have from 10 different companies, right, you are definitely paying much more than you should be paying. You could easily cut down your cost by 20%. So that's one simple sort of tip. And then, of course, another thing which we are able to reduce for our clients, at least based in Germany, is look at their utility bills. This is something which never crosses most of our minds, because we probably are living as tenants, so we don't even know whether we can actually switch players. At least here you can, and there is always a cost saving which can be brought about here. Third source of, let's say, increasing your savings could be to check how you can reduce your tax burden. Again, this is a very nation specific, location specific topic, but this is something which can always be used to figure out how you save more money. And for example, okay, this is not tax related, but goes back to the question of health, of insurances. You could also, at least in Germany, sometimes it works out that when you're switching from public to private, you actually pay lesser. And on a monthly basis, you could save even between 100 to 200 euros. Yeah. So these are some of the ideas which I just wanted to share with you quickly, because even if you are able to cut your monthly cost by 100 or 200 euros by trying to figure this out, that could be a start of your investment cycle. Now let's go on to the one more important thing, and this is something again comes from my personal experience. It's great. You cut costs and you save money, and probably you have already been doing it. Probably you're already doing 20% of your savings every month, right? But you could still be in a situation where you are losing money. For those who have saved but always kept inside money their bank accounts, right, which are not earning any interest, it is as good as putting money below your mattress or your pillow or your carpet, but the idea is where it is sitting ideal, right? This is as good as putting that money on fire. And this is a situation which I encounter in at least 50% of the families that I start working together. They are so proud of all the savings they have done. Amazing, great job. But then what you are doing with it? Yeah. And to give you an idea that why I say it's equal to, let's say, putting the money on fire. Let's say you saved 100 euros, right? As of 1st of January, you put this in your bank account, right? Where it is not earning any interest in 2020, exactly 5 years back. The value of that 100 euros on 1st of January 2025 is going to be 82.61 euros. So in the last 5 years, and just of course, just to give you an example of the dollar as well, if you have not done anything with your money in the last 5 years, you've already lost 20% of it. That's the end of it, right? So now the question, so here again, I'm going back to the people who said, they are scared of losing money by investing, or they are trying to figure out the most, let's say, low risk investments or figuring how to invest. So the first goal for all of us, if you're not doing this, is to ensure that we are not losing that 4% or 3% per annum. Yeah. So just to level up that money which we are losing, right? The first goal for all of us should be to ensure that whatever money we have saved is at least making 3% every year. That's the first thing. And that is not even investing from a financial perspective. That is just ensuring that your money is holding its value. Anything more than that, so if you're putting your money to use, anything which gives you more than 3% return, that's the actual investing, what we need to talk about, right? And this is another tip, which I guess all of us could use across all geography, is this is the lowest risk investment. Okay, again, not investment opportunity, but an opportunity where you can save your money from losing value. And these are called money market funds, right? These are the funds which invest in very safe government securities and debt securities, of course, or the debt securities of huge financial institutions besides the government institutions, right? So the risk is very low. Of course, there is always a risk, but the risk is very low. They give you on average between 2 to 4% return per annum. Yeah. Typically, at least here in Germany, we can facilitate investment into these funds without paying any fees. So the entire return that you generate is your own, and there's no fees that you have to pay. And it ensures full liquidity. So this could be an option for those people who, let's say, who've put their money into whatever you may call it, the fixed deposits or the savings plan, or how we call it in Germany, Festgeld, Spar plan, is where your money is stuck for a certain amount of time, right? Whether it's 1 year, 6 months, 2 years, and only then you generate this 2% or 3%. You can have that money fully liquid in these funds and still make that 2 to 4%. And this is a great way to utilize your safety reserve, which we talked about, like the 4 to 6 months worth of expenses. Even that, if you just keep aside, it's losing value. So the least you can do is to put money into this investment. Yeah. So that's about the most, let's say, secure way of ensuring that your money does not lose value. Now let's talk about active investing, right? So the question is in everybody's mind who have not already done that is, how do you build a portfolio? When I was going through questions, at least my perspective was majority of the audience were the beginners, right? So this is how I've kept things very simple and straightforward, keeping in mind that most of you might be at the start of your, let's say, investing experience. So going back to basics, right? When you think about investment, you need to think about three things: return, of course, yeah, what you can expect, the risk you can take. So this is this axis. And the third and the most important is, how long can you keep this money invested? Three things: risk, return, investment time frame. And these three factors determine how you should be investing your money. Yeah. Now, before we go and talk about all these different opportunities, few basic rules of investing, right? From our perspective, always go for diversification. Yeah, that's the first rule of investments is do not put your money only in one company. And here, what I mean is stocks, right? Always we prefer fund investments over stock investments because stock investments are more riskier, while funds, it's more diversified. You are investing in at least 50 companies, 100 companies with the same amount that you could put in one. And of course, there are tax advantages as well of investing in funds. You pay lesser tax, at least in Germany, the capital gains tax. Yeah. So from that perspective, from all the different perspective, diversification is always something that you need to look at. So the question which some of you were asking is that what are the stocks? How do I find those stocks? Trust me, as a financial advisor, I find that question quite redundant, very honestly. You do not have to study any specific stocks, which industry, which company has the brightest future. No, especially for beginners, just start looking at broad funds, diversified funds, investing in a large number of companies, not in a specific company or a set of companies across all geographies. Going back to the point that I mentioned, especially in these volatile times, do not put all eggs in one basket, whether it's US or China or Europe. Diversify across all geographies. And thirdly, again, diversify across all sectors to start off with. This is the start of a proper portfolio. As you go up this curve, right, there are more opportunities which are available. And I'll also talk about those specific opportunities. But as a starter, right, if you are investing, let's say, only for the first 1 or 2 years, you cannot keep aside more money than that. So stick to the more safer investments, which also means that the return could be lower, right? So for the first 2 to 3 years, right, if you're sticking to debt funds, mixed funds, or probably even real estate, this we already mentioned, you could expect something between, I think, up till 4% per annum return. Once you have more money set aside to start investing in a slightly, let's say, longer term, right? So let's say between 4 to 6 years, when you can keep your money aside, then start investing in equity markets, right? But start with, let's say, value strategy or dividend strategies, which means, so these are the companies which are, let's say, the old established cash cows, which are valued relatively lower at the current rates, and they also pay out dividends. Yeah. So this is, let's say, where a Nestle could fall in. This is where a Siemens or a Allianz falls in. Yeah. Then the next level of course, growth is the big tech, to be very simple, at this point of time. Of course, there are different other sectors which provide the high growth opportunities, but then this comes then at a slightly more risk, but of course gives higher returns. In the last year, these funds, the global equity funds, made 22%. These funds made at least 14 to 16%, but that was an unusual time period, right? Usually you can expect 8 to 10% here and approximately 6 to 7% growth here. And then, of course, comes from a fund level perspective, right? The most risky of them, China fund, India fund, right? Or healthcare fund or artificial intelligence fund. They are quite risky investments because here, you are sort of then narrowing down on a specific sector or a geography and a specific set of companies. So you're exposing yourself to more risk, but at the same time, the chances of you making money are also higher. Yeah. Then comes these specific kind of investments. So once you have built at least a little bit of diversified portfolio here, and you have money which you can keep aside for a further long period, then comes new asset classes which you can invest in, physical commodities, and we'll talk about this in more detail, which means gold, silver, platinum, titanium, real estate. Real estate is always looked at as a long-term investment, whether it is in a direct way, buying a property, or it is basically indirectly investing in other different kind of funds or investment models. It is a long-term investment, and so are the other alternate assets. Then these are like the private equity funds and all that stuff. So these are super long-term when you have the ability to take risks. When you are starting off, this is how you should start off with. In 2025, and here I'm talking about, let's say, the investors who already have a diversified portfolio, what are the specific opportunities for them, right? Infrastructure. Infrastructure in specific areas, especially in Europe, solar energy, wind energy, other renewable sources of energy, waste management. This is a great investment area, right? The second, gold and silver. I will talk a little more about this because this is something which, even if you are, let's say, a medium-term investor somewhere sitting here, could make sense for you. So this is, let's say, open to more of us. Yeah, real estate I already mentioned. And here specifically in Germany, because this is the market that I work in, um, of course, maybe the last year or the year before were the best times to invest in real estate. However, this year there still is an opportunity because the market prices have not gone up yet significantly. The interest rates are becoming more rational. The few real estate deals we have done in the last 2 months, we've got financing rates between 3.3 to 3.7%, which is still okay, and the prices are still not back to where they were, let's say, 2 years back or 4 years back, right? So this is still an opportunity. There is a time window of the next 3 to 6 months which can be used. One interesting thing, which again, a tip, yeah, for most of you guys who want to, let's say, start investing. You could also invest in the same kind of opportunities through pension funds. Yeah. Why through pension funds? Because they bring across a lot of advantages while offering the same sort of investment portfolio or management at the back end. In Germany, there are different kinds of private pension plans, but all of them come with some tax benefits, right? So in some of these options, it is also possible that, let's say, if you put 100 euros in an equity fund through your brokerage, right, and you put the same 100 euros through in the same fund through a private pension plan, and your tax rate is, let's say, 30%, that whole investment becomes tax deductible and you get that money back. Yeah. So these are the kind of options which you should look out, especially if you're starting, somewhere here. Let's say you're somewhere here at the starting point and you're starting to look at equity funds for the long term. Because mind you, all these pension plans are supposed to be long-term investments. You cannot pull money out of them in the short term. So that's one thing which you need to be aware of. But if that's something that you are comfortable with investing over the long period of time, even if it's 100 euros a month, using pension funds could be the most tax efficient way of doing it, right? And your returns as compared to an investment portfolio automatically double over the long period of time. Yeah, because whatever 30 euros you're getting back, you can further put them in investments. So it's like, increasing your investments manifold. So that's one thing which you guys should consider. Let's move ahead. Now, again, the question comes about how to do it. Yeah, how to start. The simple rule is, and it's so easy and it is so effective for most of us, but most of us do not end up doing it. So that's the irony of it, right? So what we always start with our clients is, even if you can put 100 euros every month aside, but commit to putting these 100 euros into investments for the foreseeable future. That is the best way of starting to invest. You do not have to put money in one go. You do not need an initial capital. As long as you've kept your money aside, the safety reserve we've talked about, then whatever savings you're doing on a monthly basis, put a certain percentage of it, even if 100 euros, into investments. Yeah. And what we call this effect is the cost average effect. How it works is markets will always go up and down. Yeah. What you need to do is you need to keep the amount that you invest on the periodic basis the same. Just keep the money the same, which means that over a period of time, you will buy different units of the same thing, right? Because the markets are going up and down for the let's say the same 100 euros for the next 6 months, you could buy one share of a fund, two shares, or all over. When you do this over the long term, right, what it does is it averages out the price that you have paid for that one share. Yeah. And the markets will always go up and down. Just by taking this simple example, you see that you make a profit. This, of course, is amazing. I mean, in 6 months, if I can make 450 euros, great. But the idea is to understand this concept, keep the investment the same, and not focus on buying one share of the same thing every month, but the investment has to remain same. And that automatically takes care of two things. Number one, you don't need to time the market, right? Timing the market is the most difficult thing to do, figuring out when I should jump in. Yeah. Because honestly, even if I could tell you that, then I would be sitting on the Wall Street and, running big hedge funds and all that stuff. So that's not something which you should even try to do. So very honestly, right? What you can do is to ride this volatility. And this is the best method which all of us can use to ride this volatility. The lump sum investments, right? Those need to be kept aside when the markets hit a bottom. Let's say during COVID, that was a perfect time to dump your money into the market. But that opportunity does not come, on an everyday basis. So this is something, this method works across all time periods. So this is the basis which you can try out with and keep some money aside for those rare situations. Okay, then let's quickly look at gold and silver. And this is the last thing which we're going to talk about. Um, Honestly, not something which most of us think about. Yeah, we always think about shares. We always think about, okay, even if funds, which sector and all that stuff. This is looked as something like, old age investment opportunity, but it's actually not. Look how it has grown over the last, I don't know. I mean, this chart shows probably around 50, 60 years, but in the last few years, it has rarely worked out for the ones who have invested. Last year, it was actually 40%. So this is gold. Gold price is going up 40% in 1 year. Before that, between 6 to 8%. Why is that happening now? It's happening because of these geographic uncertainties and the inflation, because these commodities are used as a storage of value. So when there is high inflation, when the stock markets are going crazy, and when everybody is jittery, this is where the central banks and institutional investors put their money. And they are still buying. So the demand is still high. For silver, what also is there is silver is not really, let's say, a storage of value, but it also has a lot of industrial usage. So from a demand perspective, right, not from a financial investors, but also from the industries. Yeah, so this is an important kind of a commodity to have. So broadly speaking, these are the two options, right, which you can always consider. And how you can invest? You can invest in as simple as, ETFs, funds, ETCs. However, there is a special form of actually buying a physical gold or silver. And that is where there are some specific tax benefits, which a lot of countries offer. Again, example, Germany. If you were to hold physical gold and silver for more than 1 year, you do not pay any capital gains tax after that when you sell. And capital gains tax in Germany is approximately 27%. Yeah. So these are the things which you can keep in mind if you have a certain amount of, let's say, money saved aside, and if you have a decent, already diversified portfolio, this is something to sort of consider, especially this year, given the kind of uncertainty. And of course, the inflation still going up, not really going down. So this could also be an opportunity. So I guess this is kind of sums up all that I had to offer in terms of my viewpoints. The last thing for the ones who are in Germany, this is a question which most of us, or most of people have always asked me, how can we help? So Famigos, as I said, is a financial advisory based in Germany. What we do is 360-degree consulting, which means we invest across all topics. Investments is just one of it. We do financing, we do budgeting, savings, of course, insurances, pension planning, everything. With regards to investments, we can facilitate investments for our clients across all asset classes, including gold, silver, real estate, of course, these funds. Uh, we do professional management of their portfolios in investment depots, right? And there are no minimum capital requirements, at least from our perspective. And everything is customized to our clients' requirements. And I think the best part is we do not have any hourly fees or retainers fee that we charge. We do not have any specific consulting fees as well. If we do onboard you as a client, and if we do start working with you, then we get automatically paid on a compensation model basis. And this is not from you, but from, let's say, the funds that we help you facilitate, or let's say Deutsche Bank, who is our investment partner when it comes to managing investment portfolios. So that's a little bit about how we can help you. So the ones who are based in Germany can always kind of reach out if you need any specific advice on investments and other topics as well. And I guess with that, I would like to thank you guys for being here and taking part in this webinar. And I know we've run out of time, and I can probably stop sharing my screen and also stop the recording, because if somebody wants to ask any questions, so the recording has stopped.